All right, we are live.
Okay. Good afternoon, everybody.
Good afternoon.
Good afternoon.
Dude,
Dr. Sanders is here, and he's the co-chair of the investment committee. Dr. Sanders, can you hear me?
Yes, I can hear you.
Okay, sir. It's on you. We're ready to start. What do you say?
What you say?
I think he said he'd like to talk.
You can go on and open. You can go on and open the meeting. What happened? Oh,
it sounded like he called to order.
You did.
did he? Okay. I didn't hear. Al,
Well,
are
I
you-
did. He's going in and out.
okay, he's having some community. Yeah, you're breaking up, Al. Sounds like you got hiccups. No, you're
This is
breaking up,
one
Al.
time we have no idea what he's
Okay,
saying.
I think he asked.
Yeah,
for
he
roll
asked
call.
so we do the roll call.
All right. Candace Carter Oliver,
Here.
Christina Bennett, Louis Cross,
Present.
Emily Hubbard, Kimberly Johnson, Shanice Johnson,
Present.
Yvette Levy, Jennifer Orr,
Present.
Bobby Richardson, Albert Sanders. It's like we
He's here.
lost him, but Doris Walker.
Here.
All right, so we do have 5, so we do have enough for a quorum.
And Christina's in the waiting room.
Yeah, here she comes.
Okay, so we have 6 with her.
Yeah, I'm sure Albert will pop back in.
Yeah. Okay.
Hi, Christina, we just finished the roll call.
Oh, great, I'm present.
Okay.
Alright.
Al opened the meeting, but he's having some technical difficulties. He's going in and out, so he's in his car. So he'll call us
Alrighty.
back. Okay, but you can go on, Chris. We're ready to. We have Gwelda
Great.
here.
We are still at 15. Welcome everyone to the investment meeting for May 2025. Roll call has been established and we have a quorum. So we'll go ahead and turn it over to Gwelda and Jeff, who's presenting today, or which I'm not sure which one, so that we can start with our agenda.
Great, fantastic. Good afternoon, everyone. And we have a couple of things on the agenda today, and one is an asset liability study, and then the other our quarterly report and the April update. And so I'm going to cover the asset liability study. So Sue, if you want to bring that up, and while that's coming up, I want to give a little bit of a background, and hopefully everybody's got their calculators out and their math hats on, because there's a lot of numbers, but actually we're going to try and make this as high level and informational and as educational as possible. But I do want to spend a couple of seconds just talking about what this is and what it is not. So you will see, and Sue, if you want to flip over to it's the page 4. Right there, that's good. So you'll see a lot of actuarial figures in here. And first off, just to set the stage, all of this data comes directly from your actuary. So I guess is in the category of what this is not, we are not trying to be your actuary. We're not trying to redo any numbers that your actuary does. That we know who Buck is. They do an exceptional job. They're very good at this. So we're not trying to recreate anything they did, but simply pretty much everything you see in this report from an actuarial basis is directly from their valuation report. All we really do with any of the numbers in here is just project some things out based on what happens with inflation over time. So inflation will change things such as expected salaries and how things actually impact and contributions and what actually impacts the overall liability side of the equation here. But other than that, we're not playing with any assumptions. That's really your actuary's job. So we know you have separate meetings with them, and they'll tell you all about mortality assumptions and again, hours assumptions and how many new folks might be coming in and how many folks might retire and go out. And so that's their job. And so we're not trying to recreate anything there. We're not trying to dictate any policy by this. Simply what this study tries to do is come from the asset side of the equation and say, it's really a key checkpoint on a couple of the assumptions that are really one main assumption that's in this report, and that's the expected return on assets. So you see for both of those years, the past 2 years here, that's been at 7%. And really, again, take out all of the mathematical magic and all the stuff that goes into this. And again, this is it's a very simple thing as to why all of you sit at this table and why you hire us and all of the professionals. It's to pay out pension benefits to retirees and their beneficiaries as well. And again, there's a lot of math that goes into what do we owe and how does that get done. But at the end of the day, we have to pay out those liabilities by stocking away money. And we stock away money every year and we put that into investments. And then the goal is to make sure that all matches and that over time, everybody gets paid their pension. So that's kind of our side of the table is the assets. So we get those assets, it comes in, we put it in the pool, and then we make sure we're investing it correctly to meet all of those obligations over time. So that's kind of at a high level, that's the name of the game. And again, there's a couple of key things, and one of which is that expected return assumption, because that's used to again, there's a lot of assumptions that go out that we're looking down the road saying we know we have a general idea of when participant XYZ is going to retire, how many years that is. We have an expectation of what their final salary is going to be and what percentage basis that what they're going to get paid out. But then we have to kind of bring that back to today's dollars to figure out how much we actually have to stock away to pay them out in the future. That's where that return assumption comes in, because we basically have to discount it, because we know money we put it in away today should be growing by something around that factor over time to get us where we need to be to pay folks out. So that 7% return assumption is pretty important. And so that's the one from the standpoint of the study that we really look at as a proof statement to say, do we have an appropriate asset allocation that has a very good probability of over time meeting that return assumption, and then ultimately what happens if we decide to make tweaks to the asset allocation? How much will it impact things? Does it get us away from that 7% assumption? And then all of that kind of feeds into what would a funded status look like? How well are we funded? What potentially might be required as far as contributions to the plan to make up for any shortfalls over time. And so again, a lot of that is just more of the actuarial side. So I think what you're going to find as we go through this is that we sort of look at some minor deviations. So maybe a little bit more equity in the asset allocation or a little less equity from where we are today as minor tweaks to see what impact that has. And again, I'm kind of giving you the spoiler here. I think you're going to find two things. Number one, the current asset allocation is very much right-sized and is designed to get us that return assumption that we're using or that your actuaries are using for all of their numbers and all the math that goes into this. And also, if you make some modest tweaks, it's really not changing a whole lot. So it's still getting you pretty much in the ballpark if we make some modest tweaks, and it's not changing what your expected funded status would be year after year after year. So well, again, we'll take a look at some of those exhibits in a little bit, but again, just want to sort of give you a general idea of what this is. What we're not trying to do is dictate any policy, change any assumptions that your actuary comes up, but this is just more of a proof statement that we have been on the right track. We continue to be on the right track for where this plan needs to be from an overall asset perspective, and how that helps meeting these actuarial objectives over time. So I'll pause there and see if there's any questions. And again, I'm not going to spend a lot of time on this first page, because again, this is directly from your actuarial valuation report. What I will tell you, and again, this is always the fun, confusing things that actuaries do, is they like to put reports in terms of the first of every year, where we tend to look at things as of the end of a year. So when you see 1/1/24, that's what we kind of think of in terms of that was the end of 2023. That's the other caveat here, is that actuarial reports, they take a lot of time to put together. And so for us to kind of get the most current picture of liabilities and the other actuarial factors takes a little bit of time. So we know that next valuation report won't come out until June of this year. And so certainly if we see anything from that valuation report that says, we might need to redo this study, we can certainly do it. But what I would also tell you is that it's probably been a while since you've seen one of these, and that's probably by design. Some of this will look familiar when we look at the asset side of looking at different asset allocations and what those expected returns are and the risk of those allocations. That's kind of familiar because that's the standard asset allocation study that we do hear very periodically. But what you don't see as often is just the kind of the marrying it up with what's going on the liability side of the equation. And again, by design, because it doesn't change all that much. So again, while it'd be great to have the most recent valuation report, we don't expect that, unless you all come back and say, yes, we significantly changed this assumption, or we've changed, what the overall eligibility structure, or we're making some major change in the overall process of how the pension is paid out or liabilities are calculated. We would say you're probably not going to expect to see a wholesale change in what that means for your asset allocation. So that's why these aren't done very often. So I would say at most we're probably doing it every 3 years. I'd say at least you want to do something like this on a 5-year cycle. But again, those are sort of the caveats here. Again, we kind of think when we're going through this, a couple of the things that we'll pay most attention to. Number one, it is that expected return, and that's something that your actuary has to come up with and make a best guesstimate. We like to work hand in hand every time possible with actuaries, just to say, is this realistic? And again, if we were to say, we think the capital market's completely changed. We don't think equities are ever going to get us any return over the next 10, 15, 20 years. And we think the best you can do on any investment structure is 6%. We'd be beholden, just as an investment professional, to tell you we don't think the 7% is realistic. And then we would have to work with your actuary and say, you have to think about moving that around, and that has implications to the liability. So again, you probably hear actuaries go through the reports a lot, but the key thing to remember from the liability standpoint, or what you actually owe, is that there's an inverse relationship between that expected return assumption and the size of the liability. So if you lower that return assumption, it actually makes the size of what you owe or the liability go up. And conversely, if you raise that interest rate assumption, it will make the actual size of the liability go down. So that's just the inverse relationship of how that compounding works. So, but again, we're not there. Again, this is the proof statement to say this is kind of where the world is at today, and we think we're in a pretty good position from the overall asset allocation of this plan. Again, I wanted to point that out because if you go back a bunch of years, the interest rate assumption for a lot of public plans was somewhere in the neighborhood of 8%. So that was back in the day when we had fixed income, which we know is a larger portion of this plan and a lot of pension plans out there. When we were getting much higher coupons and interest rates on fixed income, that was a much easier target to hit. Sort of fast forward to we've had this very low interest rate environment. And remember, not too long ago, we were at sort of near zero interest rates. So that wasn't really great for fixed income in general for those types of returns. We've had some periods of very great equity returns. And every time that happens, the assumptions come back, sort of revert to the mean. And we say, you know what, we don't think we're going to get as much in the equity markets for the next few years too. So add all of those things together, and where we used to be at an 8% return assumption over time, a lot of actuaries in conjunction with investment folks came back and said, you know, maybe our assumptions should be 7 3/4 today, and then revisit it again, and things haven't really changed. Okay, maybe our assumptions should be 7.5%. And so it kind of gets us to where we are today in the current environment of, common wisdom is right around this 7% number. So I think there's a fair amount of agreement in the industry that's a very workable number from the standpoint of what everybody's expecting from the capital markets and from the type of asset allocation that this plan has. So the other factor we'll just take a look at again that can be most impacted by what happens with the asset allocation in the investment market is that funded ratio. So that's just, again, that funded ratio is how much assets you actually have, and that's divided by what you actually owe. So when that number is below 100%, that just means the value of your assets today are less than the amount that you actually owe. And again, there's mechanisms in place to shore that up and to get it eventually closer to 100% over time. And that's really making sure that any money that comes in every year, a portion of that is recognizing that everybody is going to work another year, so we're going to owe them for that. So we have to put in enough money to pay for that. And then the other portion of it is we have this unfunded liability. So that's the second piece. So every year we stock away money, we're paying off those two components. So, and again, that's the two that probably are most impacted by what we're doing on the liability side. Again, the expected return, and then what happens in the markets and that actuarial return assumption, and how we deviate year from year from that will directly impact what that funded ratio could be at any given point in time. So those are really the two factors we're going to key in on. There's a lot of other things in here, and I pushed them, we pushed them all the way to the back of the book in the appendix. Wasn't planning on covering it today, but if everybody does have a chance, they can at least take a look at it. But again, it's just looking at factors that we sort of project out forward from what your actuary has currently told us today, and then sort of building in inflation, average inflation of 2.5% over time, and then when that compounds and grows, what does that do to things over time? What does that do to to payrolls and into other issues that actually feed back into a liability? Again, there's no magic. We're not tweaking anything outside of that, other than it's just a very basic projection that says we know there's going to be inflation. We have inflation and some sort of variability around inflation, that things are going to grow over time. Assets are going to grow, liabilities are going to grow, and what might that tend to look like? So, but again, it's a lot of that just isn't really impacted over time by the difference in what we do with the asset allocation. So that's why we're probably not going to spend a ton of time taking a look at that. So I'll pause. Any questions? Because I promised Gwelda I was going to leave her enough time to go through the reports. So Sue, why don't we flip forward a couple of pages? Right there, perfect. So this is what will be a bit of familiar territory for everyone, because every time we do a periodic asset allocation study, this is the same sort of input that goes into it. So from the asset side of the equation, this is what we're looking at when we build and think about and project an asset allocation, and will it get the return that the actuary is using in their assumption, that 7% return. So these are all of the building blocks. So in some form or fashion, we have exposure to most of these asset classes, and we'll see exactly what those exposures are in a moment. But these are assumptions that come directly from JP Morgan. So we don't, we're not making it up. We're not playing fast and loose. This is sort of something that's done by a third party expert and their economists and how they actually look at different asset classes. So you can sort of see this is what we have to work with from returns, and you can see always the objective is we want to put some things together that do a couple of things. Number one, in combination, do all of the different asset classes give us a combined rate of return that meets that objective, but also you see that volatility, and that's each asset class's ups and downs. And if you look at the chart, that's sort of visualized by how big or little those bars are. So the wider one of those bars around any of those dots, which are the average returns, that's the kind of volatility that you can expect from any asset class. So why do we pay attention to that? Because a lot of those volatilities, depending on the asset class, can be offsetting. So one asset class is having some significant upside volatility. One might be having downside, and those can offset and actually overall lower the volatility of a portfolio. So you hear us talk about it all the time, diversification, and this is why we diversify. It's to have different exposures and to have some ups when other things are going down, and overall have something that gets smoothed out on average over time. So, but again, just to give you a general sense, you can scroll across that chart and look at all the dots, and you can kind of draw a little line a little more than halfway between the 0 line and the 10% line. So that's rate of return on that vertical axis, and think about a 7%, and you can even see the numbers directly below where it says 50th percentile, and that's going to be the average expected return for each one of these asset classes. And again, that's also signified in the table to the left. So you can see there are a handful of them that over time are above that 7%. And again, by design, if you look at the asset allocation of the system, we have a fair amount of exposure to those asset classes for that specific reason. Those are the ones that have the best probability of over long market cycles getting us above that 7% return assumption. But you also see there's things that the system does have exposure to that are below that. So aggregate bonds, if you look right under bonds at 4.7%, we do hold some cash. We know that's a lower return. Some other areas of the bond market, world government bonds, that's also below the assumption. And then if you go down to the alternatives section, you see diversified hedge funds. That's one where maybe we don't fully agree with someone like JP Morgan, but again, we're not going to play around with their assumption. But I think ultimately we think you probably do get something a little better out of hedge funds than a 5% return. But nonetheless, why do we have exposure right now to things that don't have an expectation, right now to meet that objective? And again, it's diversification and it's downside risk protection, and also thinking about it, these are averages. So again, let's sort of use aggregate bonds as an example. So a 4.7% return. And then if you go over to, in that bond section, find aggregate bonds. It's kind of the first one in that yellow segment under bonds. And you see the variability in the return there. So that just kind of shows you that in any given year, they could actually have a return that's above that average, that 5%. So and generally that's going to be in a year when maybe equities don't do as well. So again, that's just the year by year variability and offset that we look for and want to have. In addition, it's liquidity, having asset classes that have different sets of liquidity and downside risk protection in certain markets. So again, averages are great to look at. They kind of help us think about things through time, but ultimately we know there's volatility and ups and downs and things that we want to offset. And so again, that's why we build a portfolio in such a manner that we do. Sue, do you want to flip forward 2 more pages? So this page brings it home a little further. Again, kind of showing these asset classes that the system is currently exposed to. The target, that is our current policy. So all of those are the percentages that the system is allocated to each one of these specific asset classes. And then what we've done is you see mix 1, 2, 3, and those are the differences, the tweaks that I talked about to take a look at a few things. So if you look at the first mix, it actually provides more equity exposure. The second mix has a little bit more, not as much equity exposure as mix 2, and then mix 3 is the opposite, actually drops our equity exposure a little bit. So again, why are we not showing big seismic changes here? And I think the main reason is because they're kind of intuitive. Well, two things are kind of intuitive. One is you can just tell by the numbers, if we were to heavily go into fixed income and make that change, well, we know because those numbers are lower, that's going to probably bring us below that 7% return. So we're really not going to entertain anything that looks like that. The other is, and this one's maybe not so intuitive, is where would be the other place that might make sense if we were to take a bunch of equity off the table? Well, it would be in alternatives, because some of those alternative asset classes, private equity, private debt, they have these nice long-term returns that are above that 7% assumption. But we all know that there's a lot less liquidity there. So we're tying up assets for a long time. Sue and her staff have a lot of money in benefit payments and expenses that has to get paid out on a periodic basis. And we have to have places to get that, and to do that, also keep a portfolio in check with that investment policy that we have. That's really hard to do when you have more things tied up in alternative assets. Now, the other caveat with the alternative assets is in these types of asset allocation studies and asset liability studies, alternatives look really good because their return streams are very different. They're, I don't want to say they're made up, but they kind of are. So we kind of know if we put a bunch of money into private equity and just let it sit there for 5-10 years and then it comes back, we can kind of calculate what we got. On an interim basis, that's kind of hard. It's not, we can't open up the Wall Street Journal or go onto Yahoo and kind of figure out like we can with our mutual funds, what that's worth today. So there's a lot of assumptions and estimations that go into how private equity is valued. So it happens on a quarter, and even on a quarterly basis, the numbers are, at best kind of loose. And so, it's really hard to judge on an interim basis. So ultimately what happens, well, those numbers get smoothed out from reality of what they are. And so they look good in asset allocation studies because they're good returns, and the volatility might not look as high as it actually is. So they're really hard to configure and look at in an asset allocation study. So how we generally treat them is just say, let's sort of put illiquidity premiums on it. Let's kind of figure out what the overall system's benefit payments and liquidity structure and needs are, and then kind of back into how much we really think we can have in these alternative asset classes. And so that's where we are, and we constrain those. And that's why, again, if we were to make some sort of wholesale change that might look good on paper for a study like this, it would generally be in alternatives. But again, that's where we have to put in the reality check and just say we can't take a whole lot of money and put it into alternatives because it doesn't make a whole lot of sense. Give me 2 seconds. I need to turn my camera off and try and close my shade here because sun's coming right in my eyes. Okay, sorry about that. I had a huge sun glare coming at me. I couldn't see. So, in any event, does that make sense to everybody? Does some of this look familiar from the last asset allocation review that we did? So this should definitely dovetail. That target mix you see will be our current allocations, and when Gwelda goes through it, her reports again, you'll see how that looks from a compliance standpoint, and that we maintain compliance with all of those asset allocation mixes. And again, we do that for a reason. It's to get this target return we're looking at over time. Sue, if you want to move forward a couple pages to page 10. There we go. So this is sort of the rubber hitting the road. So how to read this chart, either from the top if you're looking at the graphs, but I think for this one might be a little bit easier to look at the numbers in the table right below it. So here we go forward all the way out to the end of 2032, and then under each of those segments, so under 1/1/25, 1/1/27, 29, so forth, so on and so forth, you see 4 different columns. The column to the left under each one of those dates is the current asset allocation, and then the 3 that follow are mix 1, 2, and 3. So, and you can see how that projects out. If you just look for at our current numbers and take a look on a short-term basis, how this asset allocation that the system has combines to give us a return, we're above the assumption for a short-term period. So at 7.4%. Looking at the alternative allocations, again, you can see not major differences, probably what you would expect with equities being the high asset class for returns in all of these mixes, that if you add equity to a larger extent, like we did in mix 2, that the return goes up. Add a little bit of equity, not as much as mix 2, the return still goes up. And then if we actually take some equity off the table, it goes down a little bit from 7.4 to 7.3%. So again, that's shorter term. We like to think of these studies, again, more in long term and cycles. So that's where we go out further. So go all the way out to the 1/1/2033 allocation. And again, you see that just given more time and looking out, where it starts to come down to towards the average a little bit more of what we're expecting. And so again, you can see, other than that mix that lowers the equity allocation, which is still pretty darn close to the 7%, that we can tweak around the margins of that equity exposure, but we're still at the 7% assumption. So again, this is that proof statement that's good, that says we've got a good asset allocation here. The assumption that your actuary is using is right sized, and we sort of have the data here that shows that what we do and what we project out for each of these asset classes, how we combine them, will give us that return assumption over time. So which is great. This is where we want to be. So certainly what we don't want to see is a situation where we modeled all of this out, and then all of those averages over time were significantly lower, because then that would be a serious discussion to have of, do we think we realistically can get there, and can we get the assumption that's being used? So again, good proof statement that we've been on the right track, and continue to be on the right track. Now, again, a couple of things to point out and caveat with the asset class assumptions is that the equity assumptions, they will change fairly often, depending on what happens in the market. So we've had some selling off in the markets, and so when JP Morgan comes out, they start to, again, they think about reversion to the mean, so they make their equity assumptions a little bit higher than they've been, because interest rates have been higher relative to where we were a couple of years ago. All of those fixed income forward-looking assumptions are better, not as good as where they were a year ago, because we are probably going to be on a path now going forward of potentially lowering interest rates. So all of those things have to be factored. But I would just tell you, relative to where we were, let's say 3 to 5 years ago on these types of assumptions, we look much better. So does this make sense for everybody? And what I didn't address, again, if you think about the chart before, where we had each of the individual asset classes, and they all have volatility of the amount that they can go up and down around what the average is that we expect. Well, the same is when we combine all of those asset classes for the return of the system. So again, if you go out to that 1/1/2033 and you have an average or an expected median return of 7%, well, if you go above or below those to what we call the percentiles, those will say, we could have variability. We could have a situation that, depending on what markets do and how stressed they are, we could feasibly have a year that's above that, or we could have a combined experience that's above that for a 5-year period or 10-year period at 9.5%. That's sort of what we would call the one standard deviation, and then the 5 percentile, the 2. And then, the extreme would be really good if we could have great periods all the time and have consistently 15.8% return. But again, this is a game of averages. We don't see it. And conversely, we know if you take a look at those same averages that, we can be lower than that return assumption, and we can be significantly lower. And we've gone through periods like that. And frankly, this probably doesn't stress as much as we would actually like. I think for any given 1-year time period, so 1/1/25 would be really indicative of maybe a short-term 1-year time period that says, hey, at any given year, we think we could probably lose, on a stressed basis, 18 to 19%. We've been there. It certainly can happen. And so, but again, what happens is we have really good years. Again, kind of looking at that shorter term 1-year basis, it's not out of the realm that we have double digit or 20% plus returns. And so those will just average out over time. And with the expectation is that average all of those big ups, average all those big downs, and we're going to settle in somewhere around this 7%. I'll pause. Any questions?
I'm still awake.
Okay. Yes, I'm trying not to put everybody to sleep. If I start talking about normal cost and all that kind of stuff their actuary does, I guarantee I will put you to sleep. So, Sue, why don't we flip forward 2 pages? Or sorry, let's stop here. This is good. I'm sorry, you did go to actuary value of assets. Okay, so again, remember we talked about the funded ratio, and again, we show it two ways. We have up right now the market value of assets. This is the one that we kind of look at as sort of at least from an investment people, as the realistic, because we know the actual assets that we show you an investment report and what the value is. And then we sort of divide that number by what the liability is. And that's what this market value of assets is. So, this is kind of the investment guy of what we look at and what we think of as a funded ratio. So you can see where we are at, for at least from 1/1/26 from a funded status, current allocation about 66%. And then you see just by changing those allocations around for that shorter term period, again, doesn't really change that funded status all that much. Again, let's sort of go out further in time. Again, what's the big thing that changes here? Well, our study uses inflation over time to really say we think the liability is going to grow, and then our asset class assumptions are what makes the asset side of it grow. But ultimately, that's good. You see, the further we go out in time, that there's an actual improvement in that funded ratio. So again, there's a lot of assumptions that go into that, but the real key point here is just the compare and contrast between if we tweak equity allocation up or down from where we're at today, you still sort of end up in the same place. So not a big difference maker there. The next page, Sue, if you want to flip over. Let's go back to actuarial. There you go. Thanks. Again, this is the same funded ratio, but this is on the actuarial value of assets. And why this is important? Because this is the one that when the actuary calculates it, rather than the one we just saw, this is the one that the actuary says, this is what we're basing what your contribution needs to be on this value. And what does this do? Well, this again takes into account that we know that markets can kind of have a wild ride, and we can have some years that are really good above that 7%. We can also have some years that are really bad and below that 7% assumption. And so what the actuary does is actually smooths out those good and bad years to try and make it a little more consistent. And why do they do that? Because it's really trying to avoid the fact of if we have a really bad down year in the markets, that'll have a significant impact on the funded ratio. And if it does, it might artificially say, hey, you've got to put more money in this plan. So that's what they're trying to avoid with the smoothing of assets. So this is the one that we probably pay a little bit more attention to from that cost perspective of the plan. And again, you see the numbers are higher because we smooth out, and because generally how that works is when you are an underfunded plan and you have that smoothing, that it's we would expect this is going to look a little bit better from a funded ratio perspective. So you can see more on the near term number, that 1/126, right around 68% funded. Again, what I point to is that no matter which one of these different mixes you look at, the tweaks and the equity allocations, it's about the same. So we're not getting an impact one way or the other. Let's fast forward out to a little bit further, the 1/1/2034, and you see, in general, where the current allocation 85%, the other two with the higher equity allocation is pretty similar. The only one that makes a little bit of a difference is if you were to lower your equity allocation for the next couple of years, your expected funded status lowers a little bit. So again, not by a huge amount, but again, just sort of the proof statement that, again, over time with, if markets behave to averages and act as we would expect, that markets do grow the assets, you slowly, as you pay more money into the fund every year and amortize the underfunded piece of the pension, that all of that starts to shore you up and gets the funded percentage improving over time. So, but again, no major differential from what we do on the asset side of the equation to change that. So I'm going to pause there because those are sort of really the key highlights that I wanted to show. Again, if everybody has a chance on their own to take a look at the rest, it's really just more detail backing up what we covered. Again, when I look at it, I say there's a lot of things in here. Like for a good example, Sue, let's go to page 27. And again, I don't want to get us down the rabbit hole of actuarial science and things where we're kind of out of our depth. But again, we do show some charts to just talk about the liability, the growth of the liability and normal cost over time. Again, some of this will be impacted by, what happens with returns over time, but ultimately what our projection, the biggest factor in any sort of projection like this is we're saying we're taking what today's liability is, what the normal cost is, and really just growing that, both of those factors by inflation over time. Other than that, we're not getting too clever with what we do here. We're not changing any assumptions. We're not doing anything different. So again, we sort of leave that to your professional actuaries to do that. But again, this is just more to show that there is an impact in inflation, and certainly if there are significant events in the market that deviate us one way or another from that average return, that we might expect to see some impact on these factors, the liability, and again, not to get too far afield, but normal cost is just what you all incur every year. Every time we have another year of work coming up and everyone's going to work, and what are they going to get credited towards their pension? So that's what every year's normal cost is. So what we actually incur, and that's going to get tucked away to the liability or to what we owe everybody over time. So again, that's why I put stuff like this in the back. And there's a few things like that. There's a lot of assumptions, a lot of things that really that they're more your actuary's bailiwick. But this is just more of that factor of saying, giving you a visual of inflation happens, markets should be going up in the right direction. And when that does happen, we should expect to see these factors and how they're impacted over time. Questions, comments? Hopefully I didn't go too far. But I think that have impact on from an investment basis, we think we're in a pretty good place.
Well, thank you, Jeff, well done for putting together that study. Appreciate you guys doing it.
I think that was your first one, wasn't it? This is your first asset liability study?
I haven't seen one since I've been here, so I
Yeah.
don't know prior
Chris-
to that if there was one done.
Yeah, Chris might know, but I don't recall seeing.
Yeah,
one.
we've had them in the past.
We did, okay.
Yeah.
Is this the first one or the
Yeah.
third?
NDPC used to do one. Mhm.
Okay, okay.
I have a question. If I really wanted to dig deeper into this, could I call Jeff and get a real rundown of it?
You certainly can.
I really don't want to. I just wanted to say that. Just that. For anybody else.
Again, happy to do it. I would take your, drink your coffee, take your no-dos, or we can sit around and have a couple of beers and talk about it too. So,
Sounds good.
Hey, Sue.
Dr. Carter Oliver, a question.
Yes. How do we communicate this to our members? Just so that they're aware of, and not in great detail, of course, but just that, we do these types of things and they help us to make decisions, and know how what status we're in. We're in good, standing, et cetera.
Okay.
Well, I mean, this is a public meeting, so, we are sharing that. We have this in the minutes. And, include something in our newsletter that we have. We have a summer newsletter that'll be going out probably June, July. So we can include, a mention that we've completed this and, that we're on track.
Yeah.
Did you have something else in mind?
No, that's exactly what I was thinking. Like in our newsletter, just, something very short and brief, but, this is all good information. And I just think it's helpful, that members know that we do this type of, studies and we're paying attention to it. So.
And you're welcome to talk with Jeff and Guelda and work with them if you want to see exactly what Sue and all of them are going to put in there. That's fine as well.
Okay.
Sure.
I have a
Thank you.
question.
All right, dogs.
Okay, to say something to Dr. Candace, at our MRTA meetings, we discuss a lot of this about the retirees and what we're doing. And at the meetings that's held with Dr. Beckwith, with retirees, we discuss this. And at local 420 meetings, we discuss this also. So our members have lots of ways that they are informed of a lot of things that's going on with the pension board.
Okay. Thank you for that. That's helpful too, to have both those in person as well as, the printed version. I know sometimes those can be hard to attend, or if you're not a part of those organizations, you know what I mean, then you may not be attending those either. So that's helpful. And when you said Dr. Beckwith, is that Lynn Beckwith?
Yes, ma'am.
Okay, thank you.
So where are we? Sue and Albert, where are we? Are we ready for Guelda?
Yes, I believe we're ready for Guelda.
Okay. So you can bring the performance report for the first quarter.
Okay.
Starting on page 2. I'm not going to take a lot of time with the discussion on the economy and the markets because we're halfway through the second quarter. But just a few points for the second quarter. As you know, the Fed did not change rates in the second quarter of the first quarter of the year. There's a lot of uncertainty, as you all know, based upon what's going on with the new administration, with tariffs, et cetera, and different initiatives, or I should say executive orders that have gone down. So there's a lot of volatility. I think we're experiencing some of the most volatile periods in the equity markets. The few things that I will say is that in the first quarter of the year, and you'll see this in the results. The domestic equity markets were lower for the quarter, basically around concerns of economic growth and the geopolitics that are going on. What we did see was a reversal. We'd seen growth that had done very well for several quarters and several years. Actually saw a reversal with value stocks actually outperforming growth stocks and large cap stocks during the course of the first quarter. What we saw also, which is owing to making sure that we stay diversified, is international, which had not been performing quite as well on a relative basis versus domestic. International stocks actually advanced during the quarter. The US dollar declined, and there was also concern about US economic growth. And you will see that in the numbers for the emerging markets as well as developed markets further back in the report. As I mentioned, the Fed left rates steady or the same. There is a probability, a strong probability that we may see some rate reductions. Two. I think there originally was a thought that there was going to be 3 in 2025, but now they're cutting it back to 2 because of the uncertainty and the volatility in the markets. The Fed has held steady, and I'm sure all of you have been watching the roller coaster ride we've been on with respect to returns in the markets. We saw significant downturns a while back. Actually, more recently, we're actually seeing the markets, just so you guys know, this is as of a couple of days ago, the S&P was actually positive for the year, where it was down the first quarter, and for the month of May thus far, it's up 5.75%. Since the tariff announcement, we're up 9.2%. Then we saw the suspension, the 90-day suspension of 18.26%. And we're at 3.91 off the high on February 19th. So there's extreme volatility and uncertainty. The market does not like uncertainty. That's one of the reasons you saw a shift to risk off assets and where you saw value do better in the first quarter. If you turn over to your actual fund, you're going to see some of this exhibited. But so if you turn to page number 12, this is kind of to let you all know, this is what Jeff was talking about, the asset allocation. But basically, the first quarter was a volatile ride, and we're still seeing some volatility. I think until all the uncertainty regarding the tariffs is ironed out, I don't think we're going to see any stability. And it's going to be really important to see what's going to happen once the 90-day hold is lifted on the tariffs, and see what's going to happen after that. So expect to see more volatility going forward. But here, as you all are accustomed to seeing, these are your, this is your asset allocation proof page. As you can see, the little black lines in the middle of the bars is the actual target, and that corresponds to the target allocation that Jeff showed you that's on the lower chart, and it has it by different asset classes. The gray bars represent the minimum and the maximum allocation in those different parts of the market, and we try to stay within those gray bars. What you're going to see here is inverted triangles is where you actually are. So we're all within range with the exception of Global Multi-Sector and Lazard EMD. And the reason for that is that we did make a change in the global bond segment, and actually we kind of folded in some of the by all of the segments of global bonds, and now we have a global multi-sector allocation of which you hired Wellington and Loop. And once those managers are funded, you'll see that triangle move into the range of acceptability. And Lazard EMD, we actually are moving out of that manager, and we're in the process now of all of the transitions with respect to moving out of Lazard EMD, portion going to Wellington and some going to Loop. Also, some of the Manulife dollars in domestic fixed income going to Loop. But no concerns here with respect to the asset allocation. We're holding steady, and if we stay where we have has voted on to approve in the asset allocation, you should be able to obtain the 7% target return assumption that Jeff mentioned earlier. And so you can turn to page 13, and this shows you the different market value from the end of December to March 31st. As you can see here, as expected, with the market going down in the first quarter, the assets moved from 867,362,127 down to 852,931,733. So if you turn to the next couple of pages, this is something we put in every quarterly report, pages 14 and 15. These are your estimated fees for all the managers. We don't have any concerns with respect to the different asset managers and the fees that they are charging to the fund to manage the funds. Page number 16 is the commissions. We actually have commission goals in different segments of the markets. As you can see here, this is just the first quarter. So we don't want to focus too hard on this because we've got 3 more quarters of reporting. But in the domestic equity segment, we would like to see the managers at 33% for domestic equities. As you can see here, the managers that are meeting that are Westfield and Edgar Lomax. As of the end of the first quarter, Systematic is on the lower end, and it doesn't like TCW has done any trading in that area for the first quarter, but this will be more telling as the year goes on. With respect to international, the goal is 10%. Causeway has exceeded that already with a 25% allocation to NWDBE brokers. In fixed income, the goal is 10%. And as you can see here, Ernest Partners has also exceeded that goal. And in global equity, the goal is 10. And Exponences, as your global equity manager, is just slightly below at 7%. But as I said, let's not focus too much on this since it's just the first quarter of the year. And so if you can turn over to page 18, this shows the cash flow totals for the quarter ending March 31st. As you can see here at the end of that column, the first column, it has the market value of assets. Then you have contributions that came in of $9.1 million, distributions out of the fund at $25.9 million, management fees of $120,456, other expenses of $4,019, capital gain of $2,467,96. Collectively, that brought the market value down to $852,931,733. And you will see the slight uptick, even though the markets were down. You will see that on a relative basis, your fund actually did better than the policy benchmark in the first quarter of the year. Now, Sue, you can turn over to page number 27, which shows the returns. Okay, page 27, at the top here, you see the quarter return. Negative, yes. Wait a minute. No, I don't want to go there. I'm sorry. Go back one page to page number 26. You will see here a slight positive return for the total fund for the quarter ending March 31st. The top, you see 0.28. If you were invested all in indexes, you would have had a 0.12. So in a tough market across the board, you see that you got a positive return better than if you had indexed the money. The 1-year number, not quite as strong. The 5-year number is strong versus the policy index with a 10% return. And since inception, just slightly below your 7% actual assumption rate. What I'd like you to look at, though, if you look at that ranking, which is in the little parentheses next to each of those numbers, you see the rank. So you did better than your peers. Anything below 50, or say between 1 and 50, means that you did better than your peers. If it's below 50 or from 51 down to 100, that means you did worse than your peers. So if you look at the quarter and the fiscal year today, which is one quarter, you can see you've actually done better than most public funds within your size. And since inception, you're doing better at 41st than most funds of similar size. If you go down that column of quarter, you can see where you actually, where a value was actually added. In domestic equity, you'll see that the core, the large cap core, which is basically indexed, your index manager versus the S&P actually did better than the S&P, or excuse me, did right at the S&P, which is what it's supposed to do. Where you saw added value in domestic equity for the quarter, if you look down at the bottom, you'll see Edgar Lomax. Edgar Lomax is a large cap value manager. As I mentioned in my first discussion, beginning of the discussion, value actually performed better than growth in the first quarter of the year. And you can see that reflected here. Edgar Lomax is a very defensive, conservative, large cap value manager. And as you can see here, they outperformed significantly with a 6.6% return versus 2.14 for the large cap value index. And what we did, because of the style of this manager, what we've done, as we did with large cap growth, we took a portion of it and put it in the index and left a portion of it active. And the rationale for that is when markets don't perform well, or the indices don't perform well, you have active managers that can protect you on the downside. So you've got a combination there to smooth out that return. As you can see here, collectively in that segment, there was a 4.74% return versus the value index at 2.14, which ranked 10th versus other value managers. Edgar Lomax, we had some concerns over their long-term numbers because of their deep value style. And that was a rationale for putting a portion in index and a portion in active. So you can look at the longer term numbers. They are better in the 3-year number and the since inception 10-year number. But if you look at other value managers, which might not be quite as deep a value, their ranking isn't as good. So I think that that move is going to be a nice combo going forward to have a portion index and a portion active in that segment. Now, so you can turn to the next page, which shows the other portions of domestic equity and international. We see here large cap growth, which had a tough quarter and has been doing very well. But you see here large cap growth off 9.37% versus the index at negative 9.97. Slight outperformance versus the benchmark. TCW, as you can see, is your large cap growth manager, actually protected in a very difficult large cap growth market in the first quarter with a negative 0.82. But if you had been indexed only, you'd have been a negative 9.97. The reason we have this split is because growth, the large cap growth index is extremely concentrated, and a lot of managers could not beat the index. And I can see there for the 1 year, and those numbers rolled into the longer time period. We had about seven stocks that were concentrated in that index. So, and managers will not violate, they should not violate restrictions within their policies to be too concentrated, because you can see what happened here. The index had a negative almost 10% return during the quarter because of that concentration. And you see that TCW was able to protect in the in that type of environment. So as a result, you see here, we did the same things we did in large cap value. Then if you go down the page, you see here, you've got your other portions of domestic equity, Westfield representing small cap growth, Systematic representing small cap value, and DFA representing a value, but in the micro cap of the very, very small. If you look at this, you see here Westfield protected, albeit negative, protected in a down market, delivering a negative 10.37 versus the index in negative 11.12, and did better than the average manager at 47. If you look at the long-term numbers, you can see here Westfield has done a good job for the fund on a long-term basis, with the exception of the 1 year time period. They have exceeded the return of the index that they're benched against. Systematic had a tough quarter and actually underperformed in that small cap value segment. Basically, their sector selection, most importantly in information technology, hurt them. Information technology was one of the worst performing segments in large cap as well as small cap during the first quarter of the year, and their sector selection there, and they're underweighted some of the better performing segments of utilities and financials hurt them in the first quarter of the year. No concern there, because if you look at the longer term numbers for Systematic, we don't want to focus too much on the short term, but if you look at the longer term numbers in the 3-year, 5-year, 10-year, and since inception, that manager has exceeded that Russell 2000 value index, their market benchmark. DFA, in a tough market, also protected on the downside, delivering 8.97 versus the microcap benchmark at 9.5. And if you look at that manager long term, you can see they have significantly exceeded their benchmark in every rolling time period and ranked above their peers in every time period measured. Now, the positive stuff we saw, as I mentioned earlier, international was where things rallied this quarter. Part of it due to the lack of strength in the US dollar. As you can see here in your developed international portion of the fund, there was a return collectively between Fidelity and Causeway of 7.75, which is the developed portion of international, and it ranked 25th. You look at the numbers here, you'll see that segment has done well relative to the EAFE index in all time periods measured, and basically have done better than the average international portfolio, with the exception of since inception is a little off. The star here for the quarter was Fidelity, which is represented international growth. As you can see here, Fidelity had a return of 5.8 versus their custom benchmark at 2.3. They ranked 19th, so better than about 81% of their peers in the first quarter of the year. And if you look across the page there, you can see that they have exceeded the return of their custom benchmark and having mixed performance in that longer time period versus their peer group. Causeway, they basically had some holdings in semiconductors and semi-equipment that hurt them during the quarter, but they still ranked 40th. They represent international large cap managers, international large cap value managers. But if you see, they rank better than their peers at 40th. And if you look at the long-term numbers for Causeway International Value Manager, they've exceeded their benchmark and ranked well above the median in every time period measured. They've been with you since 2005. Then you can turn forward to emerging markets, which was another area of the market that did well positively. As you can see here, you have two managers representing emerging markets. You've got DFA and you have Invesco. DFA actually has done well, not only for the quarter, but also long-term versus its benchmark, and ranked well in most periods of exception since inception, but still above their MSCI emerging markets benchmark. Invesco has had a little bit more of a tough time. Their stock selection in consumer discretionary, real estate, and industrials hurt them. Also, the underweighted China, and also some stock selection in China has hurt them for the quarter, where they only delivered 2.28 versus the index at 2.93. We have had this manager in, and we're continuing to look at their performance and possible replacement due to some of their longer term performance, and they're still not meeting up to their index over time, as well as their ranking versus their peers over a period of time. Exponence is a manager of managers, and they're a global manager. As you can see here, for the quarter, they protected in this market with a negative 0.51 versus the world index at a negative 1.32, and ranked 42nd versus other managers that manage like them. A little bit tougher of a period for 1 year and 3 year, and the since inception, albeit not up to the world index, which is basically within that 1 year period that has hurt them, but they still delivered a 9.1% since they were hired in 2020. Before we move forward to fixed income, any questions on domestic or international equity markets? Okay, if not, so you can move to page 29. This is fixed income. As you can see here, fixed income collectively delivered 2.4% versus 2.63. You can see here, if you look down into domestic fixed income, it's pretty much right in line. The manager that delivered the most excess performance in the first quarter of the year was Ernest Partners, delivering a 3.2% versus 2.78. Manulife faltered in the first quarter of the year. But if you look at both of these managers for the 1 year, the 3 year, the 5 year, 10 year, and since inception, both managers have delivered performance in excess of the Bloomberg aggregate, which is the broadest domestic fixed income benchmark. So core fixed income, no real worries there. Then we looked at an opportunistic, and this is a segment that we are doing some allocations, and it's in flux right now. Hopefully we will have those managers, Wellington and Loop, incorporated into hopefully the next report. So you see here for the quarter, opportunistic, the Loomis Sales Strategic Alpha Fund, under the custom benchmark and not ranking so well. But if you look at the longer term numbers, which is what we focus in on, this manager has done fine. The 1 year number, 9.2 versus 3.3. The 5 year number, 3 year, 5 year, and since inception numbers, they have delivered in excess. And in those time periods, with the exception of the 1 year, exception of the quarter, you can see that manager has ranked very high in the first quartile of their peers in all those time periods measured. We won't talk about tips because it's just basically mimicking the tips index. Neuberger Berman, opportunistic fixed income manager. We had to do a benchmark reset here because it was off a bit. But as you can see here for the quarter, albeit not as strong as their custom, it's not as strong in their peer group, but in excess of their custom benchmark at 1.32. And if you can see the longer term numbers, we had to rejigger that. And so now that we have everything straightened out, that should look better. But on a long-term basis, we're going to give them a little time to see how they do in that opportunistic bucket. Lazard EM is one of the managers that we actually have been terminated, and they're in the process of liquidating, and they will go towards the funding of the managers that were hired in the last couple of meetings. If you turn over to page number 29, you see there, that's the Global Asset Allocation, PIMCO All Asset Fund. As you can see, their custom benchmark was flat versus their other peers, though. You can see PIMCO All Asset actually had a good positive return of 3.44 and was at the top of the heap with respect to other managers that managed like them. If you look at the 1 year number, strong. The 3 year number, not as strong. 5 years, 10 years, and since inception, the All Asset Fund has delivered in excess of their custom benchmark. And then lastly, we have another positive area. We have the hedge funds. As you can see here, hedge funds actually delivered positive returns collectively between White Box and Grosvenor. Intrust is actually in liquidation. And as you can see here, the star this time was White Box. Collectively, they have done well. Over the past year, the star has been White Box with a return of 11.2 versus 6%. Grosvenor, a positive return of 8.6 versus 4.32. Long-term numbers for both of these managers since inception of each of them have been in excess of their respective benchmarks on a long-term basis. And then lastly, on page 31, we've got real estate. As you can see here, you know this had been a tough area, and we had gone into requested a distribution queue, but then we came out of the queue and we're getting lower fees and also getting a return here. As you can see here, you'll see a turnaround in the Trumbull Property Fund as well as the Trumbull Property Income Fund. Both funds above their respective benchmark, above the Odyssey in the first quarter of the year and ranking well versus other real estate managers. For the Trumbull Property Fund ranking 34th and the Income Fund 25th. As you can see here, this has turned around significantly. We did have some hiccups and we're still seeing recoveries in real estate over time. But collectively this quarter, they delivered an excess of the NCREIF index at 1.03 versus 0.9. And that rounds out the first quarter of the year discussion, which is old news. Any questions before we move to something more recent, which would be the month of April? Okay.
Were you gonna look at the watch list?
Oh, I'm sorry. The watch list, which would be in the back of the report. Oops, go back. Okay. We had Edgar Lomax on watch. As you can see here, we've actually seen a improvement. Oops.
Uh-oh,
Sorry.
it's okay.
You can see that, as I mentioned, they improved over the course of the first quarter, and you see they pass now. So we'll continue to watch that monitor and look for their 3 and 5 year returns to come up above the peer group, which is where they're failing and index return for the 5 year. So we're seeing improvement there. So, you know, right now just they remain on watch until we start to see some of the rolling longer term numbers come up. TCW, we have a fail there. And the reason that is because of, as I mentioned earlier, the concentration of that large cap growth index. We did see that manager actually protecting in what was a difficult market. We talked about Invesco and that we're watching that, and there's a possible search with respect to Invesco emerging markets. At Spinance, no concern. That manager's only been with you for a few years, and as far as and they don't have a 3 and 5 year time period yet. So we would like to give them more time. In fixed income, you see the only managers we have in that fail column is the Neuberger Berman Global Opportunistic Fixed Income. As I mentioned, we had to do a benchmark adjustment there. Lazard EMD is no longer, or they're in liquidation for the fund. The PIMCO All Asset, if you remember, that one actually is starting to improve, and so their 5 year rolling return and their peer group moving for the longer time period is better, but because they failed in the shorter time period, that's why they are on watch. So no new additions to the watch list, but there are a couple of managers that we're looking at more closely. Okay. If there are no questions, we will go to the flash report. And Sue, if you'll turn to page 1, just to give an update on what happened in the month of April. Okay, there you can see a general idea of what happened in the markets in the month of April. You look in that column that says month. As you can see here, the areas where we saw positive numbers for the month of April, the Russell 1000 growth, which represents large cap growth stocks, and again, international. The developed markets at 4.6, EM or emerging markets at 1.3. And you see for the 3-month period ending April, the only 2 areas that actually had positive numbers were international. Further, the reason for diversification amongst your asset classes. In fixed income, you look down below, you see that the areas of strength, you see the Barclays or the Bloomberg aggregate at 0.39. And again, international bonds positive at 2.9. And you see that for the 3-month period, we actually only had one area that was negative, which was corporate high yield. Now, what I would like you to look over to is on that right-hand side. I know you all have probably heard the news how hard assets are actually increasing. If you look over that, it says commodities, you can see the jump in gold from year to year. And as you can see from 12/31 to 4/30, the jump in the price of gold and the commodities area. You also see a jump in silver and you see a jump in copper. And so that kind of gives you, kind of frames the discussion as to what you'll see in a couple pages for your fund. So Sue, turn over to page 2. This is another, we do this every month, so you can see where you are. Basically the same thing that we saw through the end of March. The 2 areas were out of compliance until the transitions are made of the global multi-sector and Lazard. But you can see there where you are with respect to, you're all within your minimums and maximums in the asset allocation. You move forward, Sue. Okay, the fund market value at the end of April was 847,495,668, and I believe that's a let me see. Basically, the return was flat. You have a 0.03% return for the month of April, which is below the policy index. So we saw weakness in the month of April, and all of that has to do with a lot of the volatility that we've experienced in the markets and the tariffs, et cetera. If you look down that column, you can see here across the board, you're seeing some difficulties. Large cap core, which is the S&P 500, was off. As we saw earlier, large cap value had done well, but in the month of April, we see they underperformed the Russell 1000 value index, negative 4.35 versus a negative 3.05. We did see TCW come back, and they actually had a return of 2.64 versus 1.77. And so that has helped their fiscal year-to-date return, which is less negative than the Russell 1000 growth. If you go forward, you can see why we were basically flat. You can see in the smaller cap and mid cap areas of the fund, you can see here Westfield protected on the downside, and so did Systematic. Now, the one manager that had done well in the quarter actually is off this time period of negative 3.24. Collectively, that segment was slightly off from the Russell 2000, representing small cap stocks at negative 2.43 versus negative 2.31. International, where we had seen a lot of strength by the international segment, was off this particular month. Fidelity at 2.86 versus 5.2. Causeway 1.28 versus 4.0. But as I said, we don't focus in on month numbers. We look at the longer term. This just is to keep us abreast of what's going on with the managers on a month-to-month basis. We also saw not as strong as we saw EM in the first quarter. You can see here DFA, Emerging Markets Value Manager, a slightly negative return, a negative 0.09 versus the benchmark at 1.31. Invesco Emerging Markets 0.14 versus 1.31. And then you can move over to global equity on the next page, not as strong there. Positive number, but not as strong as their custom benchmark, a 0.38 versus 0.93. And going over to fixed income over on the next page, you can see we're here where the managers collectively were not as strong in fixed income versus the custom benchmark, 0.5 versus 2.86. In the core segment, Manulife was off this quarter. Ernest Partners pretty much held steady and was in line with the benchmark at 0.37 versus 0.39. And you also see this reflected below in a weaker fixed income performance from Loomis, as well as Neuberger was just right on top, 8 basis points off. And the Lazard EM, as I mentioned, I actually had a positive return in they're in liquidation. And then you move over to the next page, your global asset allocation. As you know, that was an area of strength before. As you see here, it's off slightly for the month of April, a negative 0.17 versus 1.68. Now, where you had strength was in hedge funds. As you can see here, in a negative return for the hedge fund multi-strat index of a negative 0.64, white box actually protected with positive 0.32, and Grosvenor a 1.1% versus their benchmark 0.36. So we have ebbs and flows. Of course, real estate does not report on a monthly basis. So those numbers would not be in this report. You won't see real estate returns until the June 30 report. And basically, at this point in time, we're kind of holding to wait and see what's going to happen. Things change from day to day. The markets were actually positive today. The S&P was up, the NASDAQ was up, and the Dow Jones Industrial was up today. But, who knows what tomorrow will bring. And a lot of this has to do with nervousness by the market, a lack of certainty about what's going to happen with the tariffs. So as a result, we're seeing extreme volatility across the board in the markets. Any questions or comments from the committee members? Or Jeff, would you like to add anything to the discussion?
No, that's excellent recap.
Okay. Thank you all for your attention. And I believe that's all we had.
The only thing we need to touch on is about the meeting next month in June. That would normally be held the third Thursday, which is June 19th, which is a holiday, Juneteenth. So we just need to verify everyone is good if we just move the meeting to the following Thursday, June 26th. I think Gwelda and Jeff, you are available.
Yes.
And then PNC is planning to come in and just present on their, I guess, an annual as the custodian for the first year.
I think I can make that date as well.
The date is fine with me. I clear my schedule.
Sue, I'm available only up until 5 p.m. on that day. I have another board meeting that evening that begins at 5:30.
Okay, thank you.
As of now, I'm able to attend.
Are you going to be in the country, Shanice?
Yes, ma'am.
Ready to go, charged up.
I'll be there.
Look at things here. There it is.
Somebody needs to mute.
Okay. All right. Well, I think we'll plan on June 26th as our next meeting, and then July, we typically don't have a meeting, so we would go into a break after that.
Sounds good.
If
Sounds like a plan.
no other business, there's no other business, I'd like to get a motion to adjourn.
I make a motion that we adjourn this amazing meeting. The investment committee is the best.
Second.
Thank you, everyone. Have a great rest of the week.
All in favor?
Thank you.
Hey, everybody.
Thank you all.
Everybody, have a good weekend.
Good
See
night.
y'all later.
Bye, Jeff.
Bye-bye.
Jeff Gwelda, you all enjoy the weekend.
Take care.
Bye-bye.
Thank you.